What is up YouTube? Welcome back to the FFX Academy. So I hear you want to find out whether there is or isn't a correlation between NFP, Non Farm Payroll, and the gold USD spot market. Well, guess what? You're in the right place, because today I'm going to show you whether there is or isn't a correlation between Non Farm Payroll and gold prices. And also we're going to do an analysis based on the best 6 historical NFP data and the performance of gold and see if there is a correlation or not. Also, I'm going to show you how to trade gold today. I have my setups ready. I'm going to show you all the possible scenarios. So stay tuned. It's coming. But before we do that, please consider subscribing to the channel and smash the like button. It's coming now. Before we move into any forecast or any analysis, it's important that we understand why is the NFP important and what is the NFP. The non-farm payroll, which, any jobs created outside the agricultural sector in the United States of America, accounts for about 80% of the workers who contribute to the US GDP. So you can see that it's a really big number, because all the people who generating and adding value to the US GDP are counted into this number. So you can see now why traders watching it, as it tells a lot about the condition of the labor market. NFP is also closely monitored by the Fed, as they show whether and how quick the economy and inflationary pressure are growing. Central bankers consider fast rates of job gains as potential, leading to an increase in inflation. And guess what? Gold is one of the best, or was one of the best, inflation hedging asset. So there is some kind of correlation, but I'm going to show you historically what's happening this year. Is there a correlation between NFP data and gold? Well, bad news is there is no clear long-term correlation. It's shocking, right? Despite this, NFP does move gold and can whiplash $10 to $30 within seconds. So you ask the question, if there is no correlation, how you should trade it? Okay, so I mentioned that I'm going to show you how to trade it. This year, we don't have any normal market conditions, so I made a forecast or analysis about the past 6 NFP data and the performance of gold. And remember that 2020 and 2021 are not normal market conditions. If you go back in history, maybe you can find some correlation between the textbook teaching, the textbook economics, and the performance of gold based on NFP data. So first I'm going to show you what is the textbook economics. So good news for the US labor market, or actually better than expected, is positive for the dollar. So it's bad for gold, as it becomes more expensive because gold is denominated in US dollars. And usually on NFP day, gold tends to fall, then or spike down, then move up fast. So in case of bad news, or worse than expected, the direction is reverse to the above. So once again, worst case scenario, if the NFP data is worse than expected, then it's bad for the dollar, which means gold becomes cheaper to buy and speculators and investors are going to buy. I'm not gonna bring in any more, economic data and inflation and interest rate, because that would just confuse you. And you have to remember that whatever is in the economic textbooks, the market doesn't care. So whatever I've been taught at university, I realized that sometimes these things doesn't work in real markets, because real markets are moved by money, by speculators, by investors. They're not moved by some models and theories in economic textbooks. So that was a lesson I learned. And you asked the question, forecasting NFP. Is there a way to forecast NFP? Yes, there is a way. You have to know that the ADP, or National Employment Report, is a measure of the monthly change in non-farm private employment based on the payroll data of approximately 400,000 US business clients. The release 2 days ahead of the government data is a good predictor of the government's non-farm payroll report. The change in this indicator can be very volatile. So if you want to find out the ADP data, you can download it in a PDF. I try to add a link in the description below, or just join my free Telegram channel, link in the description below. I'm going to upload it to there. So now we discussed what is NFP and why is it important. Let's look at the charts. Okay, on the chart you can see the gold USD spot market on the 4-hour time frame, and I collected the past 6 NFP data, and we're going to look at the performance of gold. We're going to compare how gold is reacted to NFP data based on the economics behind it, based on the economics it's been taught at universities. But remember, markets don't care about economics, and we're going to see the real example that the markets are random. So the data goes back all the way from August, so that was the last NFP data. You remember the flash crash, so you can see that this was the flash crash, 6th of August, and the data is going back to March for 6 months. I didn't want to go anything beyond 2021 really, because we're not in normal market conditions, and that's exactly what I want to represent to you. That's the message I want to pass, that we live in uncertain markets. There is no normal market condition right now, and this is why there is no correlation between NFP. Maybe there was a correlation for 6 months or 2 years between NFP and gold data, but right now there is no correlation. And if you look at the past 20 years of historical data, there is no correlation between NFP and gold. So starting with 5th of March 2021, NFP was better than expected. And remember what I said, that if the data is in line or better than expected than the forecast, so it's positive for the dollar, which is bad for gold because it becomes more expensive to buy bullions and gold in general. So what happened straight after NFP is gold went up and then down. So if NFP was better than expected, gold should have gone down, but instead gold went up. And then before the next NFP in April, 2nd of April 2021, gold went down again and retested the 1680 level. And what happened on 2nd of April on NFP data was again better than expected. So again, based on Economics 101, which has been taught by university professors, that's what I've been taught. If NFP was better than expected, which means that the labor market is doing well, it's positive for the dollar because investors looking at, the US is doing great, it's booming. Where you want to put your money if you're an investor? Of course, you're going to bet on the winner, which is the United States of America, because the labor market is booming. So it's bad for gold, right? But look at the market and reality. Gold went up, and not just up, it went higher. So what the fish is happening here? And look at the next one, which is 7th of May 2021. The NFP data was actually worse than expected. So in case of bad news or worse than expected, the expected direction is reversed to the previous examples. So NFP is good for the dollar, it's bad for gold. NFP is worse than expected, it's bad for the dollar, good for the gold. But we have to start factoring in the inflation. If NFP is actually better than expected, wouldn't it increase inflation? Because if all the workers in the United States are earning money by working and then they're spending it in markets, in whatever supermarket they go in, that would increase prices higher and higher and higher. So maybe that is the reason why NFP is acting weird, and this is why maybe speculators and investors are going against the economic teaching, and the NFP doesn't have long-term correlation or consistent correlation between gold and NFP. And the other thing that is important, and I want to talk about and highlight, that why we don't have normal market conditions and why NFP data and gold performance is inconsistent, is because each and every NFP is followed, or there is a statement or there is a meeting of FOMC members, and the communication is different because the Fed and Jay Powell, they have a tough job because they have no idea what's happening in the US labor market and the US economy, because the economic data is inconsistent. And they have to communicate something because the statements of the FOMC, all the meetings, all the minutes and statements are designed to move markets. But how can you expect this poor guy to do anything if the data is inconsistent? If the if the labor market is overheating in the US, it means that inflation is going to be out of control. There's going to be a hyperinflation. So that's the number one mandate of the Fed, to control inflation, keep it at 2%. So what happened in May is that the Fed started to communicate that going back to March, the Fed communicated that they don't care about inflation and they're going to let inflation go above the 2%, 3%, 5% level because inflation is transitory. But in May, what changed is the Fed actually said, okay, so data is not the NFP, but other CPI and PPI and inflationary data was actually higher than expected. So the Fed started to communicate that, okay, guys, we need to do something. We need to start thinking about stopping monetary policy, stopping quantitative easing, i.e. tapering, and also we need to think about increasing interest rate, which is a really aggressive method of the Fed or central banks to control the money supply in the economy. And if they're increasing interest rates, it spooks the markets. And what happened after 5th of May? Gold price went up, and then we had another NFP data on 4th of June. And what happened after? Gold went up a little bit, but then it was melted. So what's happening? It's completely different, completely opposite than the previous data, the previous month. And there's only like 31 days in between the data release, the NFP data. So what changed here is you shouldn't focus on solely of the NFP data. You should look behind the data. You should look and focus and listen to what the Fed has to say about monetary policy. Okay, so going fast forward to July 2021. Again, data was better than expected. So better than expected data based on the textbook economics, which I've been taught at university, should be bad for gold because it's US dollar positive news, which means the dollar should become more expensive, so gold should go down. But instead, what happened is gold again went up and down and up again, and it was moving in a channel for quite a while. It was really, really painful to watch. But in general, gold went up. It was positive. So again, it's completely against the economics of of the financial markets. And then we arrived 6th of August, where the data was better than expected, and it was just almost in line actually. But what happened here is that the Fed, previously of the NFP data, communicated that we're going to step into the market, we're going to stop the quantitative easing, and we're going to increase the interest rate earlier than expected. That was the clear communication, that was the words of Jay Powell. And look what happened. The US traders went absolutely crazy and they started to sell, and they stopped the market somewhere around here actually. So that was the market close, and it wasn't a bigger fall than this one. It was considerably big fall, but it wasn't, something crazy. But what happened after is that the Asian traders, they had no chance to react to this data. They had no chance to react because they finished work. The Asia is behind or ahead of the US market. So what happened after? On Sunday, when the Asian market opened, all the Asian traders went back to work, and they saw like, oh my God, NFP is better than expected. We need to sell all our portfolios. So what they did, they started to sell, they started to panic sell. But what's happening in the Asian market? There is absolutely no liquidity, which means that the brokers and the prime brokers, the big institutions that serve these hedge funds, these corporates, and these big Asian trader firms, they have to execute the orders based on market price, based on the whatever they quote. And because there is no liquidity, there are no other counterparties who would expand the spread and give other kind of quotes, they cannot match the orders, so they have to execute the orders whatever the client gives in the market. And that, my friends, caused a massive vacuum and pushed down gold price. And that was the flash crash. That was the whole reason behind flash crash. But it's in the past, so now we should focus on what's happening with NFP and how you should trade it. And now we're moving on to the forecast, guys. So just to recap, I presented you the past 6 NFP data and the performance of gold, which is inconsistent. You cannot make any conclusion based on these data because the market condition is not normal, and you should not solely rely on whether the data is better than expected or worse than expected. You have to know the reasoning behind NFP data. What is the intention of the Fed? If you don't know what's the intention of the Fed, what is the plan, you're lost, my friend. Do not trade around the NFP if you have no idea what's happening in the Fed. So, flash crash. Price went down all the way to 1680, and you can see this was 1680, so it was the previous NFP data, and it took 1 month for gold to recover. It took almost 30 days to recover, and currently we are hovering at the previous flash crash price. So what the hell is going to happen? If you think about the algorithms work on past historical data, and the past historical data shows a big ass drop. So based on past historical data, algorithms should sell gold. But the communication of the Fed and Jay Powell in Jackson Hole was different than previous month. They said, we're not going to go with the aggressive interest rate increase. What we're going to do is we going to wait 12 to 18 months when we have, you know, markets calm down, we have better conditions, we know what's actually happening in the labor market, in the gold market, in the US economy. We're not going to raise interest rate now. We're going to step back and we're going to use something softer. We're going to use tapering in a slow and gentlemanly manner. So it's really calmed the markets, and that's why gold is actually started to go up. And it was the opposite communication than last month. So if you're confused about what's going to happen, I don't blame you, because it's confusing. And I think what's going to happen is all the big players are going to wait. Who's going to fart first and then move? But you know, it's not good enough. So I'm going to show you how you should trade gold. Right now, gold is respecting really well this bullish trend line. So what you need to focus on, I'm just going to go to the 4-hour chart, because you know, it's better to see like this way. You can see that gold gives us a really nice bullish market structure. So going higher highs, where's my pencil tool? Gives us higher highs, high lows, higher highs, high lows. So it's beautiful market structure. So what do you think would follow after a higher high? Of course, a higher low. And you can see that there is a nice bullish trend line along this way. So based on simple price action, and it's really just a prediction, you shouldn't trade it if you're not confident enough, and please do not risk more than 2 to 3%. But based on simple price action, price should follow this structure. So if you were to continue this market structure, my best guess, my best educated guess would be, based on you know, historical performance and what's happening in the market, I would say gold should come down all the way to 1794, 1799, and then move up. The reasoning behind it is because we had forward guidance finally from the Fed, and it looks like Jay Powell calmed down and said, okay, we're not going to raise interest rates straight away because that would be silly. We have inconsistent data, we have no idea what's happening. So they admitted again, they did it in May as well. So you cannot even trust the Fed anymore. But what's happening if they said that inflation is transitory, but it's going to stay with us? They say we're not going to raise interest rates in the next 12 to 18 months. So what does it mean for us? If they're not going to raise interest rate, they're not going to actually control inflation in an aggressive way, which means that inflation is going to stay with us. And because prices are sticky, or there is some kind of elasticity, but it's more rigid, the prices, because once you raise a price, the only way to decrease that price if you start a full-blown price war, price competition. And retailers and, you know, traders and producers, they're not in the situation that they can afford a full-blown price war, a full-blown competition. So they're not going to lower the prices. They're going to pass on to consumers, which means inflation is going to stay with us. Maybe the rate of change, which is going to change. So maybe inflation is 5% this month, it's going to be 2% next month. It doesn't mean it's changing inflation, it's changing the rate of change. So that's why I think inflation, if it's staying with us, investors and speculators are going to pour in money to gold, which means gold price in the long term should go up. But because we know what's happening with gold before NFP data, we know exactly that the gold price, you know, should drop down and follow the bullish trend line and the market structure. So this is what I'm waiting for, guys, and that's my forecast for next week. But don't go anywhere, because I'm going to show you contingency plan. So what's happening if gold price breaks the market structure and comes down below this trend line? Well, it's very much possible, because we don't know what's going to happen. We don't know how algorithms are going to respond. Is there going to be another panic selling? We have absolutely no idea. So in case if gold price falls below 1780, 1790, we have price action, we have previous market structure, we have previous bullish trend line. So what you need to focus on is how gold is going to react to these levels. Previous market structure, so we have trend line, we have previous low. So if the price breaks the previous market structure, so this lower high and this trend line, and it comes back to retest, then it's going to be our entry to our selling. And what is the exit level? Well, you can look at the chart. It is the previous low, which is sitting at 1680. So guys, I gave you my view on NFP. I showed you there is no correlation. I showed you what I'm waiting for. So actually I'm waiting for price to break this, follow this bullish market structure. But I gave you also a contingency plan. So what's happening if price doesn't follow this plan? I hope you enjoyed this video, guys. If you get any value out of the video, please consider subscribing and smash like button. This is the Alpha FX.